Insolvent. The 31B Repo spike that just killed the silver breakout. The December 31st anomaly. At precisely 9:30 p.m. Eastern on December 31st, 2024, silver experienced a catastrophic 5% collapse from 83 to 71.39 within a single trading hour. Simultaneously, the Federal Reserve executed a $31 billion overnight repo injection, marking the largest liquidity intervention since the March 2020 pandemic crisis. This convergence demands rigorous examination. The technical evidence. The price action revealed a textbook shooting star formation, a modest body with extensive upper wick, signifying violent rejection at resistance. This wasn't organic profit-taking, which manifests gradually across distributed timeframes. This was institutional-scale capitulation. Gold declined merely 0.5% to $431 during the identical period. The divergence is statistically significant and mechanistically revealing. The physical-digital disconnect intelligence from global dealers indicates profound dislocation. Tokyo, $130 per ounce. Kuwait, $106 per ounce. COMEX screen price, 71.39. This arbitrage spread represents more than premium volatility. It exposes fundamental supply scarcity against synthetic price suppression. When physical metal commands 45–80% premiums above paper quotations, the electronic price ceases to reflect genuine market clearing mechanisms. Window dressing, the regulatory camouflage. Year-end window dressing constitutes sophisticated balance sheet manipulation. Financial institutions temporarily restructure positions to present regulators with sanitized snapshots at fiscal boundaries, then revert to actual exposures post-inspection. The mechanics are straightforward. An institution carrying catastrophic losses on December 30th must present regulatory compliant metrics by midnight December 31st. Rather than absorbing losses permanently, they engineer temporary cosmetic improvements sufficient to satisfy statutory requirements. The insolvency hypothesis. Consider this scenario. A major institution established short positions at $30 or $40 per ounce, anticipating mean reversion. Silver's parabolic advance to 83 generated mark-to-market losses, approximating 53 per ounce on hypothetical exposure of 600 million ounces. Calculation: 600 made ounces set $53.31.8 billion in unrealized losses. Including forced liquidation costs, margin requirements, and settlement obligations, total capital requirements approach $35 billion, remarkably congruent with the Fed's $31 billion intervention. The institution faced binary choices: declare insolvency or engineer temporary solvency through coordinated intervention. The Fed's strategic imperative. The Federal Reserve's mandate isn't silver price stability, it's systemic financial stability. When a systemically important institution faces collapse from concentrated derivatives exposure, contagion risk becomes existential. The Fed intervenes not to manipulate commodity prices, but to prevent cascading institutional failures. The $31 billion wasn't seasonal housekeeping. Seasonal adjustments don't require pandemic magnitude interventions. Corroborating evidence. The COMEX simultaneously raised margin requirements to $25,000 per contract, a defensive maneuver designed to expel leveraged participants and reduce systemic exposure. Margin increases of this magnitude signal acute counterparty risk, not healthy market functioning. Volume evaporated post-collapse. Legitimate profit-taking generates sustained volume as positions transfer between participants. This volume profile indicates market paralysis, participants waiting to assess whether price stability represents genuine equilibrium or artificial suppression. Critical monitoring framework. 3 indicators will determine whether this crisis was resolved or merely deferred. 1. The $71 threshold. If silver maintains support above $71 through January's first week, the underlying supply squeeze remains active. The December 31st suppression was purely tactical, sufficient to satisfy regulatory snapshots, but insufficient to extinguish fundamental demand pressures. 2. COMEX, open interest. Dramatic open interest collapse confirms successful short position unwinding via Fed liquidity. Sustained elevated open interest indicates the short position persists, temporarily masked but structurally unresolved. 3. Ongoing repo operations. If the Fed rolls forward substantial repo operations, injecting additional $20 to $30 billion, the underlying institution remains on life support. The emergency isn't concluded, it's ongoing. The physical reality principle. Institutions command sophisticated paper market manipulation capabilities. They've demonstrated this capacity repeatedly across decades. They can engineer screen prices to satisfy regulatory requirements or technical chart patterns. They cannot, however, manufacture physical supply. As long as physical metal trades at substantial premiums to paper quotations, the paper price represents artificial suppression rather than genuine market clearing. The physical market will ultimately force reconciliation. The only variable is timeline. Strategic positioning. My approach centers on $71 as the decisive battleground. If $71 holds through January 7th, this confirms tactical suppression rather than fundamental weakness. Physical accumulation becomes strategically advantageous, exploiting the gap between 71 paper exposure and 100 plus physical reality before market reconciliation. If silver breaches $65, $68, this signals deeper systemic unwinding beyond cosmetic window dressing. Full liquidation events demand complete position absence until structural stabilization emerges. If repo operations exceed $20 billion weekly, this confirms ongoing institutional insolvency requiring continuous Fed support. Directional risk-taking becomes imprudent when billions flow through emergency facilities daily. Historical precedent. The September 2019 repo crisis demonstrated identical structural patterns: unexplained overnight rate spikes, emergency Fed interventions, opaque explanations, and subsequent narrative management. The playbook remains consistent because the underlying vulnerabilities remain unaddressed. Conclusion. The reckoning approaches. They achieved their December 31st objective. Balance sheets satisfied regulatory thresholds, but physical metal remains scarce. Asian premiums persist. The structural shortage intensifies. Paper markets can suppress prices temporarily through coordinated interventions and regulatory theater, but they cannot suspend physical laws of supply and demand indefinitely. The competition for physical metal has entered a new phase. This transcends short-term price prediction. This concerns whether paper derivatives can maintain price discovery dominance, or whether physical markets will force complete systemic repricing. The data reveals institutional desperation. The Fed's intervention confirms systemic fragility. The physical paper disconnect exposes manipulation, unsustainability. 2026. As opening week will determine whether the closet door holds, or whether the accumulated contradictions finally force reconciliation between digital fiction and physical reality.